You are not losing money in VOO. You are just leaving it somewhere else. In the past 12 months, while VOO faced headwinds from tariff pressure and megacap rotation, 3 specific ETFs returned between 39 and 47%. That gap did not happen by accident. It happened by architecture. And one of those 3 is not what you think. Today I am showing you the Triangulated Portfolio. 3 ETFs, 3 different market regimes, one architecture that performs in all of them. And the regime map I will show you in the second half of this video reveals something about 2026 that I have not seen any other channel explain. Stay for that. Before we go any further, this video is built for investors who already hold VOO or SPY as their core position and want to understand how a satellite layer can outperform the benchmark during specific market regimes. This is not about replacing your foundation. It is about what performs on top of it. Here is the structural flaw that most passive investors never confront. VOO is not designed to tell you when it is underperforming specific alternatives. It is built to track the market, and it does that with exceptional efficiency. But the market is not one regime. It is at least 3, running in rotation. And a single broad market fund cannot be architected for all 3 simultaneously. That gap between what VOO is built to do and what the market actually requires is exactly what the Triangulated Portfolio addresses. By the end of this video, you will understand exactly when each of these 3 funds outperforms, when it doesn't, and how to position all 3 alongside what you already own. That is the blueprint. Let's build it. Subscribe before we go any further. Next Thursday, I am breaking down the fund Goldman Sachs built that takes the same Nasdaq 100 momentum exposure as one of today's 3 ETFs and converts it into monthly income. Since October 2023, it has outperformed every competitor in its category on total return. Subscribe now and catch it when it drops. Point 1. SPMO, the growth engine. When most investors want to beat the S&P 500, they try to pick individual stocks. They read earnings reports, watch analysts, study charts, and most of them still trail the index. SPMO solves this differently. Instead of you doing the work of identifying winners, the fund does it algorithmically. Every 6 months, automatically concentrating your exposure into the 100 stocks in the S&P 500 with the strongest recent price momentum. The mechanism. Momentum works because markets are slow. When a company reports exceptional results, institutions take weeks or months to fully price in the news. A stock that has been rising steadily tends to keep rising before the full market catches up. SPMO captures that drift at scale. Trailing 12 months, plus 42.93%. Category average, plus 15.66%. 5-year annualized return, 18.46% versus VOO's 14.67%. Expense ratio, 0.13%. You are getting systematic alpha at index fund prices. The honest picture. SPMO's semi-annual rebalancing means it reacts slowly to sudden sector rotation. When momentum breaks, and at some point it always does, SPMO can fall harder and faster than the broad market. Nearly half the fund sits in electronic technology right now. If that leadership rotates, SPMO will feel it acutely. Growth engines burn more fuel. That is not a flaw. It is the mechanism. Know it before you deploy it. Before the quiet trade, I want to know where you are right now. Drop your current setup in the comments. VOO only or something else. One line, no judgment. I read every one, and your answer shapes what blueprint I build next. Point 2. GLDM, the safety net. I told you one of these three is not what you think. Here is what most investors have in their mental model about gold. Boring, slow, maybe 3 to 5% a year if you're lucky. Here is what GLDM, the SPDR Gold Mini-Shares Trust, actually returned in 2025. 64.21%. An additional 8.5% year-to-date in 2026. Trailing 12 months, 39.55%. In a year that has been difficult for equity investors, the boring trade has been running. Here is the mechanism. When global uncertainty spikes, geopolitical escalation, inflation pressure, banking stress, institutional capital moves to safety, not to your savings account, to gold. GLDM gives you access to that move at 0.10% per year, one of the lowest expense ratios of any commodity ETF available. You are not buying GLDM because you are pessimistic. You are buying it because uncertainty is not a temporary visitor to the market. It is a permanent resident. The honest picture. GLDM pays 0 dividends. Your only return is price appreciation. In a pure growth environment, where SPMO is returning 40%, GLDM may return 5 to 8% and feel like a drag. That is exactly how a good insurance policy should perform. You do not want your insurance to be the best performing asset in your portfolio. You want it there for the moment everything else needs it. Tax note. Gold ETFs carry collectibles classification in the US, which means a maximum 28% long-term capital gains rate. Verify this with a tax professional before acting. The interaction between these three funds, why they work together rather than competing, is in the regime map. I will show you exactly that at 6:15. Before we get there, the third fund. Point 3. PAVE, the diversifier. The Global X US Infrastructure Development ETF holds 101 companies involved in building, connecting, and maintaining the physical infrastructure of the United States. Industrials at 74%, basic materials at 19%. Top holdings: Quanta Services, CSX, Eaton, Train Technologies, Union Pacific, Deere. Not one of those names appears in SPMO's top holdings. That absence is the architectural point. Trailing 12 months, PAVE has returned 47.87%, the strongest TTM number of the three funds in this portfolio. Year-to-date in 2026, PAVE is up 3.45%, holding positive territory, while VOO is negative. Since inception in 2017, its average annual return is 16.30%. AUM stands at over $13 billion, with nearly $1 billion in new inflows in the past 3 months. When institutional money moves into a fund at that pace, it is not noise. It is a positioning decision. The macro driver for PAVE is structural rather than speculative. The infrastructure commitments made in recent years lock federal dollars into physical projects spanning multiple years. These are contracted revenue streams. Quanta Services builds power transmission lines. CSX and Union Pacific move freight. Eaton manufactures electrical equipment. This is the economy you can see, hear, and touch. And in 2026, it is outperforming the economy you can only read about on a screen. The honest picture. PAVE charges 0.47% annually, more than 3 times SPMO's cost. Over a 20-year holding period that compounds into real money and should factor into your allocation sizing. PAVE is also cyclical, tied to economic growth and interest rate conditions. Its 2026 YTD of 3.45% tells you clearly that the physical economy is not the dominant regime right now. But its trailing 12-month return of 47.87% confirms it is a powerful instrument when its regime runs. PAVE is your positioning for when the build accelerates. Here is what I told you the regime map would show. In most years, one market regime dominates. In 2023 and 2024, AI and technology dominated. SPMO ran. In early 2025, geopolitical escalation dominated. Gold ran. Mid-2025, infrastructure reshoring dominated. PAVE ran. Sequential, one at a time. But look at 2026. The tariff environment is suppressing mega-cap tech. SPMO's tailwind is compressed, but still positive. Dollar uncertainty and the Iran situation are running gold. GLDM is active. Infrastructure spending bills are still executing. PAVE is holding positive. All 3 regimes are simultaneously present. That is not normal. That is exactly why the triangulated portfolio is relevant right now. Not as a theory, but as a 2026 specific architecture. The institutional framework is called Core Satellite. Your core stays in VOO or SPY. Long-term, stable, lowest cost. Your satellite positions in SPMO, GLDM, and PAVE capture the alpha available in specific regimes without abandoning the market. You are not replacing your foundation. You are adding architecture to it. Here is the risk map. Every fund in this portfolio has a condition that breaks it. SPMO can fall faster than the market it tracks when momentum reverses suddenly. And it will, eventually. GLDM will frustrate you in years when equities return 20% and gold returns 5%, which describes most normal market environments. PAVE carries the highest fee of the 3 and is tied to an economic cycle that does not run every year, as 2026's YTD figure confirms. None of these is an all-weather fund. The triangulated portfolio does not eliminate regime risk. It distributes it across 3 different regimes, so that when one fails, another is likely running. That is the architecture. That is the honest version of it. Here is the tax-psych reframe. Every retail investor is told, own VOO, hold forever, trust the market. That is not wrong, but it is incomplete. It assumes the market runs only one regime, and that regime always rewards patience. 2026 is demonstrating what that assumption costs. The triangulated portfolio is not an alternative to the market. It is a more precise way of participating in it. You deploy the growth engine when growth is running, the safety net when safety is required, the diversifier when the physical world is being built. The pattern was not hidden. It was just not widely distributed. You now understand something that the majority of VOO-only investors in this country do not. You understand that the market has regimes, that different structures perform in different regimes, and that a portfolio designed for only one regime is leaving 2 unaddressed. That is what the triangulated portfolio fixes. And now you have the blueprint. One question before I give you the Goldman Sachs blueprint, and I need you to answer it in the comments right now. One word. Core, if you are staying VOO only and today's video did not move you. Satellite, if you are adding one of these three to your existing position. Triangulated, if you are building all three layers. Your answer shapes which path I build next. And there are three different directions I can take, depending on where this community lands. I read every comment. One word. Drop it now. Subscribe so you catch Thursday's blueprint. Next week, the fund Goldman Sachs built that takes the same NASDAQ 100 momentum exposure you just learned about in point 1 and converts it into monthly income distributions, hitting your account every month, not just price appreciation. Since October 2023, it has outperformed every major competitor in its category on total return. Not distribution yield, total return. The ticker is on screen for 3 seconds. Then it's gone. The full blueprint drops Thursday. The pattern was here the whole time.